wrap. Good morning, everybody. Top of the morning to you, all you magnificent melon heads out there. Today is August 31st, 2023, the last day of August. Say it ain't so. Where'd the summer go? I don't know, but September's coming, everybody. Top story this morning is U.S. job cuts. They're on the rise. We got even more data that says the U.S. job market not as strong as they've been telling us. Just like I've been saying all year, that the jobs market data does not fit the headlines that they've been pumping out there. Why haven't we been seeing wages rise as fast as inflation if the job market was really so tight? If there was really this hiring frenzy going on in the economy, how come people's wages weren't rising as fast as the cost of food and cars and rent and everything else was going up? Labor has been getting cheaper relative to life. That's not a strong jobs market. That's a weak jobs market. And the data is finally starting to reflect that. And of course, bizarro world where bad news is good news, this means stocks are going higher on this news. Today, it was Challenger job cuts. This is a private sector report, and it reported that the U.S. economy cut 75,000 jobs last month. Now, guys, I just want to add that this is not a net gain or loss. Challenger job cuts only counts layoffs. But we got 75,000. That is up from in the 20s last month. Big jump in the number of layoffs. And this fits a lot of the anecdotes that are starting. Have you guys noticed for the last week or so, we're starting to see this uptick of the stories about 500 layoffs here, 1,000 layoffs here, 10% of the workforce here. It's starting to sound an awful lot like in the beginning of the year in January when we were getting all the big layoffs in big tech and all the layoffs in the financial institutions. Now, that went away back in January. That stopped right around March, coincidentally right around the time the Fed started pumping liquidity to stop the bank runs. Interesting. But now it's coming back, but it's not coming back in tech sectors, and it's not coming back in the financial sectors. It's coming back everywhere else. Yesterday, we talked about a furniture company. Today, we're going to talk about some other ones. It's now everywhere in the economy. These layoffs are starting to pile up again. I don't think these are quite yet reflected in any of this unemployment data. It's going to lag. It's going to take a little while, but I think that spike in unemployment may be just around the corner, and the Fed is still raising interest rates. They're still tightening, knowing that there's a lagging indicator. The jobs that we're losing right now, we're not losing them because of the last rate hike that we got in August. We're losing these jobs because of the rate hike we got last August. And they've been raising this whole time, which means there's a lot more job losses on the horizon. And also this morning, we got some more data out of China, some more manufacturing. The Chinese PMI, or Purchasing Managers Index, it's a measure of how strong manufacturing activity in China is. It came in contraction territory again. That is several months in a row. Now, it's contracting slower than it did the last few months. So there's a silver lining there. Chinese factory activity is shrinking, but the pace of shrinkage is down. I guess that's a good thing if you're desperate for anything good to talk about this economy. But China is the world's factory. It is the world's growth engine, and it's making noises. Jobs are being cut. Manufacturing in China is shrinking. The world's economy, the engine of the world's economy, is making funny noises, and stock traders are just sitting there giving it gas, driving along, saying, number go up, yay, NVIDIA. It's not going to end well. And with that, it's time to shrink my big melon of a head. And while I'm shrinking my melon of a head, won't you please smash that like button? It's very good for the YouTube algorithm. It helps the channel. And if you're new here, please subscribe. We do this every morning. I'd love to see you tomorrow. The fear-greed index is still in neutral territory, but above the 50 mark. So we're just ever so slightly leaning towards greed at 51. Right now, S&P futures are up only 6 points this morning, or 0.14%. They've been bouncing around a little bit, but pretty much unchanged at the open this morning. The Dow is set to open, however, 136 points higher, or 0.4% to the upside. That has come down a little bit since we got the PCE data and some other economic data this morning. Personal consumption expenditures came in pretty much in line with expectations. So no real change to the inflation narrative in the U.S. economy this morning. We also got the NASDAQ futures are set to open down about 8 points or a negative 0.05%, but stocks are pretty much unchanged on the day. Now, the DXY, on the other hand, is a little bit higher this morning. It's up 30 basis points after getting crushed yesterday because of some lackluster jobs data and the belief that, hey, the Fed is going to not loosen, or at least stop tightening. A lot of people betting on a Fed pivot soon. But the Dixie's lower right now at 103. The Dixie is higher this morning at 103.46, up 30 basis points. And the reason for that may have to do with this data that we got out of Europe this morning, the Euro area inflation rate. The annual inflation rate in the Euro area remains steady at 5.3% in August. That's more than 2.5 times above the ECB's goal and above the market consensus of 5.1%. However, core inflation rate, this is all the way down here, the core inflation rate that takes out volatile food and energy, that actually came down to 5.3%. That's down from 5.5 last month. So right now, central bankers are more worried about core inflation than they are the headline inflation that includes commodity-driven prices like food and energy. And core inflation is coming down, and you can see here, this is the Euro area headline inflation rate. We had a peak of 10.6 back in October of last year, and we've been coming down sharply, grinding a little bit lower. Now, we were pretty much unchanged with the headline number today, but remember that core number is still coming down. So inflation in the Euro area is starting to come down. That doesn't mean prices are coming down. I want to just emphasize that means prices are going up slower than they were last month or the month before that. But this is starting to drive the belief that maybe the European Central Bank is done with their rate hikes. If the European Central Bank is done with their rate hikes and the Fed might still hike, well, now the euro is weakening this morning. The weakening euro is making the dollar look stronger, sending the DXY higher. Excuse me, guys. I'm still fighting a sore throat here. Looking over at the bond market this morning, we got yields are lower pretty much across the board. 30-year Treasury yielding 4.22% this morning. That's down 2 basis points. 10-year yielding 4.10. That's down about 1.5 points. The 2-year Treasury yielding 4.88. That's down 1 point this morning. And the 1-month Treasury at 5.39. That's up 1 point. Yields continue to drop, guys. Again, these are bets that the Fed probably done with their rate hikes. I disagree personally. I think the Fed is still going to hike in November. I look at what Jerome Powell said in Jackson Hole, and then I look at the jobs data that came out since then, and I don't see enough data to tell me that Jerome Powell is going to change his tune. The September rate hike has kind of been off the table for a while now, so the real question is, what do they do in November? Looking over at the commodities board right now, we have got gold is a little bit lower this morning. We've got December gold futures trading at $19.71. That's down about $1.65. September silver futures trading at $24.59. That's down 14 cents this morning, or about 0.58%. West Texas Intermediate crude oil, October futures trading $82.70. That's up about $1 this morning, or 1.31%. And we got platinum and palladium are pretty much unchanged. October platinum futures $981, and December palladium futures trading at $12.28. But here is the big data point from this morning. This is United States Challenger job cuts. U.S.-based employers announced that 75,151 jobs were cut in August of 2023. That's the most in 3 months, rebounding 217% from the 11-month low of 23,697 cuts in the previous month. That's according to this report by Challenger, Gray, and Christmas. This is private sector data. The result pointed to another period of softening in the U.S. labor market, suggesting that the Fed's aggressive rate hikes, yada, yada, we know where that goes. But this is an important quote we've got here. Job openings are falling, and American workers are more reluctant to leave their positions right now. We saw that in the JOLTS report a few days ago. That's what sent the stock market sharply higher a few days ago. And we saw that job quits were down. So we're seeing that also reflected here in the job cuts number. People are less likely to quit their job because there are fewer openings and there are more layoffs happening. And so people are staying put. People are happy to have a job. This is let's see, the job market is resetting after the pandemic and post-pandemic hiring frenzy, said Andrew Challenger, senior VP of the employment firm. It was estimated that around 30,000 of the job cuts were due to trucking giant Yellow Corp's bankruptcy filing in the period. All right, so we went from 23,000 to about 75,000, right? So a bump of more than 50,000. 30 of them were from yellow. That still means there was an additional 20,000 or so job cuts elsewhere in the economy for the month of August. So that's important. Here's the chart here. You can see where we've been for the last few months. Now, we were way down. We saw job cuts were coming down after that big spike in January. That was all the big tech layoffs happening here. Now we're coming down, and we've got a big jump back up, partially driven by yellow, but yellow only accounts for about 2/3 of the increase. So there's other job cuts happening here. Now, we're also getting some more jobless data today. We got, let's start with initial jobless claims. Now, this was kind of interesting. Initial jobless claims in the United States decreased to 228,000 for the week ending August 26th. Okay, you can see that here in the chart of initial jobless claims. This is weekly data. Now, we've been falling for 4 weeks in a row. Initial jobless claims, when somebody loses their job, it takes a couple of weeks for them to show up on the initial jobless claims data. So I suspect that these anecdotes of layoffs that we've been seeing in the press recently, namely yellow, which just showed up in the Challenger job cuts, I don't think that data is yet reflected in the initial jobless claims. So initial jobless claims are still ticking down, even though layoffs are piling up. All these people who are getting laid off right now won't show up in this chart for a couple of weeks. Now, continuing jobless claims, again, this is a weekly snapshot we get every week. Continuing jobless claims increased to 1,000 or 1.7 million, basically. That's for the week ending August 29th. So these are on the rise. We've got continuing claims have been starting to tick up really since the middle of July. Now, what this tells me, even though the pace of people losing their jobs, according to the initial claims data, is down, people are spending more time on unemployment benefits because it's taking them longer to find a new job. And that's why the continuing jobless claims number is starting to slowly creep up, really for about a month and a half now. This chart reflects the reduction in job openings that we saw in JOLTS. And this chart also explains why people are quitting their job at a slower pace, because it's harder to find a new job now. That's already starting, and it's starting just as the layoffs are starting to pile up. So again, guys, the jobs market not as strong as they're advertising, and it's all about jobs at the end of the day. It doesn't matter how much financial engineering goes on between NVIDIA and CoreWeave and Magnetar, and I will be talking a lot about that in the coming days, mind you. Doesn't matter how much of that happens. At the end of the day, if people can't afford to buy stuff because they're out of work, then none of this is going to work. If there are no jobs, guys, there's no economic activity. And let's talk about jobs, because we got this story just came in last night. Actually, last night. Zebra Technologies to lay off 700 employees, around 7% of its workforce. All right, maybe you're saying who? Zebra Technologies? Never heard of them. I get it. It's not a huge number of layoffs, and it's not like a big Fortune 500 company, but it's another one of these anecdotes about a few hundred lives thrown into chaos, a few hundred more people losing their jobs. That's paychecks that aren't coming in. That's mortgages that are at risk of going into foreclosure. That's car payments that aren't getting made. That's bank balances that are going to get drawn down. So this is economic problems starting on a small scale. Now, Zebra Technologies, these guys make mobile computer products and things like mobile barcode printers. This is all inventory management technology at Zebra Technologies. All right, you know, that portable barcode reader, and it's got a little printer, and you can slap the sticker on the thing in the inventory at the warehouse. That's what this company sells. Now, we've been talking for months about how the PMI data is just garbage in the United States. We've seen manufacturing activity contracting. We've seen new orders have been in the toilet. No stuff is getting ordered. We've seen how the shipping companies are not moving as much stuff. We've seen how the Chinese manufacturers are not making as much stuff. Well, the company that manages the inventory has less stuff to manage, and so they're laying off their workers because there's no orders for their stuff. This is, again, how the knock-on effects, the contagion, how it starts to spread. And all these PMIs and the shipping data, it's starting to translate into people being out of work. It's taking longer than a lot of us would have thought, but it is happening. 700 more people going on the unemployment rolls. And there was also some disappointing jobs information hiding in HP's recent earnings report. I talked about this on my Zoom call yesterday. Shout out to my Patreon supporters. Thank you guys for everything you do for the channel. HP earnings disappointed. All right. And, you know, HP, all right, it's kind of like a .com stock. Nobody really cares. But all the way down, about halfway down this article, there was a little bit of a hint about what's going on in the jobs market. The CEO is saying PC prices are not improving as quickly as we expected. They noted while demand overall was stronger than expected, in particular for consumer PCs, but there's continued high levels of industry-wide inventory. Jesus, I can't talk this morning. Continued high levels of industry-wide inventory and pressure pricing. So, yeah, high inventory, but he's not talking about inventory rising. He's talking about the market is shrinking and there's still so many PCs on the shelf that is putting downward pressure on pricing. But then he goes on to say, at the same time, a slowdown in corporate hiring, among other factors, has reduced enterprise PC demand. White-collar people are not being hired. White-collar people are being laid off. And so their companies don't have to buy as many computers to give to their employees. And it's starting to hit HP's earnings. So again, the weak job market is showing its ugly face all over the economy right now. Zebra Technologies, Yellow Trucking, and even HP selling fewer PCs because the job market is weaker. And more data that supports that, China's manufacturing PMI. It just came out this morning. The official National Bureau of Statistics, again, Chinese government data, so take it with a grain of salt. It rose to 49.7, but keep in mind 49.7, that is still in contraction territory. These PMIs, anything below 50 means manufacturing activity is shrinking. So yes, it shrank slower, but it's still shrinking at 49.7. Now that's up from 49.3 in July and exceeding expectations of 49.4. But I just want to talk about a couple of the subsets of this factory because one of the best statistics in this whole chart here, in this whole thing, business sentiment, when they ask purchasing managers, what's your opinion of the overall economy? Business sentiment improved to a 6-month high, coming in at 55.6 versus 55.1. Now, I mention that because, guys, keep in mind, China just made it illegal to say the word deflation. Remember that we were talking a few weeks ago about how China was saying, economists were being warned about negative economic sentiment. So take the walk with me here, guys. In an economy where it's illegal or where bad things might happen to you or your family, you might just disappear in the middle of the night. If you say anything negative about the economy, and then the guy from the Communist Statistics Bureau shows up at your factory and asks you about your opinion of the economy, are you going to tell the truth? Or are you going to say, hey, number one economy, good job, Beijing, keep up the good work. We're all happy here. We're all good here. We're all fine here. How are you? What do you think they're going to say? I'm just shocked. I'm shocked, I tell you, that business sentiment is on the rise in China when they just made negative business sentiment a crime. Go figure. It's funny how that works. And if you take that away, manufacturing is falling even faster. All right, now here you can see, this is the chart of China's manufacturing PMI, all right? These numbers back here in last December, this was their ridiculous zero vid policies that I don't want to talk about, get my channel in trouble, all right? They were way down here because they were locking down all the factories. Nobody was allowed to leave the factory. There was riots at the Foxconn factories. And then we had the glorious, magnificent China reopening story. You guys remember that one? Remember how the China reopening was going to reinvigorate global growth and oil demand was going to explode higher? Not so much. We got 3 months of expansion in manufacturing. That was the magnificent, grandiose China reopening. One of those months was 50.1, which was in expansion territory by 1/10 of a point. Again, see also Communist Party statistics and government censors. Then we had 2 months of pretty good activity, 52.6 and 51.9, before slamming down in April after the U.S. financial crisis, and we have been in contraction territory ever since. The China reopening was a dud. It was a failure. The world's factory is slowing. It's not good for the global economy. And we're seeing that elsewhere, guys. Country Garden warns of default risks. This one just hit the tape yesterday. They are deeply remorseful, though, so you got that going for you. If you bought a Country Garden bond and you lost all your money, don't worry. They're deeply remorseful, so you got that going for you. They're deeply remorseful for the record loss. China's largest private property developer warned on Wednesday of default risk if its financial performance continues to deteriorate and said it felt deeply remorseful for its record loss in the first half. Well, gosh, don't I just feel better already? But I want to scroll all the way down to some important quotes here. This is the CEO of Country Garden saying, if the financial performance of the group continues to deteriorate in the future, the group might not be able to fulfill the financial covenants of these borrowings, which may result in default in these borrowings and cross-default in certain other borrowings, the developer said in a filing. So they're just stating the obvious here. Guys, we might not be able to pay back some of these offshore bonds, these U.S. dollars that we borrowed. We're not making enough yuan to buy the dollars, especially because the yuan is weakening against the dollar. So we need to make even more yuan to buy the dollars to pay them back. They're saying we may not be able to make that payback. Now, they're also talking about cross-default in certain other borrowings. A lot of these bonds have clauses in them where if the developer defaults on any of their other bonds, it would automatically trigger defaults in the other bonds that they haven't missed the payments on. So this is the contagion risk, and this is the counterparty risk going on here. If Country Garden defaults on one bond, they default on many bonds all at the same time. And then we need to start worrying about who do the people Country Garden owes money to, who do they owe money to? That's when that becomes a contagion risk, and the second, third, and fourth dominoes start to tip over. And they also mentioned something else here that I thought was noteworthy this morning. It added that it will consider debt management measures to cope with the remaining overseas debts coming due through the end of June next year, including negotiations with onshore banks on renewing and extending existing loans. Now, the key words in this statement here is they're going to look into debt management measures for overseas debts, so dollars and euros borrowed, and that they're going to work with onshore banks to renew and extend existing loans so that they can cover those overseas debts. Now, that's a big shift in some of the policy that we've seen with these Chinese developers. Like with Evergrande, they told their offshore investors, the people in their dollar bonds, they basically said, you're SOL, good luck to you, we're not paying you back, we're only interested in paying back Chinese citizens. Well, that started a wave of capital flight out of China. When offshore bonds weren't being paid back, foreign investors were no longer willing to lend money to Chinese companies. And China is a debt-based economy. They are dependent on all of that debt coming in to fuel future growth. So now we're seeing a change in their policy here. This is Country Garden is saying, we're not going to automatically default on our foreign investors. We're going to work with our own banks, which are basically state-owned enterprises. We're going to work with our banks to get more loans so we can pay back the American and the European investors that we owe money to. Evergrande didn't do that. Country Garden is saying we're going to do that. This means that the Chinese Communist Party has become acutely aware of the danger of foreign investment in China drying up. That's a big deal. They've been fighting capital flight. See also the videos I did about that Singapore money laundering bust. They're trying to prevent their own citizens from taking their money out of the country, but they're also trying to protect the flow of dollars and euros into China, something they haven't been willing to do in recent months. And the last thing I want to talk about, global rice supplies, guys. Keep an eye on this one. The food story is coming back. Global rice supplies tighten after India's July export ban. Something is going on in rice markets. Rice prices in key exporting countries, including Thailand and Vietnam, have climbed around 20% since India, the world's biggest shipper of grain, banned shipments of a key variety in July, tightening global supplies. There's been some floods in certain parts of the rice-growing world, and there's been droughts in other parts of the rice-growing world that's disrupted production. And because of those floods and droughts, India has banned rice exports. So global rice prices are on the rise. Now, guys, rice makes up 20% of global calorie consumption, and the price of rice is up 20%. So a 20% increase in 20% of global calories, that means on average, food prices have risen 4% this year, just being driven by rice. I mean, wheat and corn are doing their own things and soybeans are doing their own things. But rice alone has contributed to a 4% rise in global food prices. That's a huge deal, guys, because we still have a large percentage of the world's population that lives right on the brink of starvation or right on the brink of the poverty line. And a 4% increase in food prices or a 20% increase in the staple food crop of the global south, that's going to push people further into poverty, and it's going to push some people down into starvation. So keep an eye on this story. Something's going to happen in the rice market here. Either India needs to let up on their exports. There are stories about they're planting extra acres now in response to these higher prices. Hopefully that results in new supplies in time. But big things happening in global food markets, guys. Keep an eye on that one. It was wheat last year after the Russian invasion. This year, it's rice. And I have to say thank you very much to Mr. Robin R.C. Batsafe. He says China could actually stimulate. They've been trying to stimulate. They've been doing a lot of these little, prancing around the perimeter of money printing. They've been lowering rates, but they are trying to stimulate. Xi is good at scaring investors. Guy has no idea about economics. It's mostly unknown, but his speeches are telling. Now, I'll be honest, I don't speak Mandarin, so I can't, or Cantonese for that matter, I can't listen to Xi's speeches and tell you what he's saying. I have to go through the filters of translators, and most of his speeches don't get word for word published in U.S. press anyway, so a lot of that doesn't get here. Good at scaring investors. Yeah, I think he is. Xi is a scary guy, so he should be good at scaring investors. And not for nothing, investors should be scared of the Chinese economy right now. It's a mess. As much as the U.S. is a mess and Europe is a mess, I think China is even worse. And yeah, you're right. He has no idea about economics. Remember, it was Xi Jinping's 3 red lines policy that really burst the Chinese housing bubble. It was meant to slowly deflate it, but as it's commonly said, you just can't taper a Ponzi. Thank you very much, Mike Binder, sir, for the super chat and the support of the channel. You are a gentleman and a scholar. And thank you, Mr. Steve Woitis says, I wonder if Windows 11 has government spyware and control built in for CBDC compatibility. I swear my tinfoil hat shiny side in. Tinfoil hat time, brother. Will Windows 11 have government spyware built in for CBDC? Well, guys, place your bets. It's 2020's bingo time. Who had government spyware forced out in a Windows update? Did anyone? Any of you guys in the back? Yeah, Steve, we're putting the tinfoil hat on for that one this morning. But you know what, guys? It's the 2020s, and let's not say what they will or won't do. They've done quite a bit in the 2020s already. This is not a time to underestimate what they are capable of. I appreciate the creativity, though, and the reference to the tinfoil hat, sir, very much. And thank you for the super chat and the support of the channel. I appreciate that, Steve Woitis. And last but not least, guys, I would be remiss if I did not remind you to get your tickets for the Silver Symposium. We have just 29 days left, September 29th, October 1st, at beautiful Caesars Palace in Las Vegas. I will be there. Let's meet up. Let's have a drink. Let's talk about not politics. Let's avoid politics at all costs and talk about finance and markets and economics. And, of course, my favorite of the shinies, silver at the Silver Symposium. All your favorite YouTubers are going to be there. Looking forward to meeting you guys in Las Vegas. All right, everybody, that's all I got for you today. I want to say thank you so much for the super chats, and thank you to my Patreon supporters for supporting the channel. Links down below to all that good stuff, including that affiliate link that'll get you 10% off your Silver Symposium tickets. Hi, Mom. Hi, Dad. I love you guys. And until next time, live small and dream big.